Okay, reading 47, multi-factor models. Ladies and gents, we'll work through the learning outcome statements in a second, but what I can tell you at the moment is that there is a massive amount of resource being thrown into the space. There is a lot of academic institutions that are starting to commercialize themselves to take advantage to explore these factors. And this is, I don't want to say an exercise done in vain, but really, ladies and gents, at the end of the day, if people can come up with over 300 factors, the so-called Factor Zoo paper, then let's just take today with a pinch of salt. And once again, this is the section that there's no disrespect to CFA whatsoever, because if you look in the material at the 3 PhDs that put the section together, I'm nothing in comparison. I'm just saying in South Africa, relative to what people are talking about, the material can catch up slightly. For example, Farmer French has done work in 2015 that's not included in these notes. The Holy Fathers themselves have maybe. Sorry, no offense to religious people, didn't mean to do that. Okay. Now, some learning outcome statements. We're going to talk about arbitrage pricing theory. And we're specifically going to talk about how it overcomes the shortcomings of the CAPM model. Kind of no one really uses it, but in any event, we do to some degree. We're going to define arbitrage opportunity. I'd probably bore you all to death if I go over it in detail again, but it's short. We're going to calculate the expected return on an asset given sensitivities and premiums. That's where we start to get into the multi-factor APT type stuff. Macroeconomic models, fundamental factor models, and statistical models. We're going to have a look at, luckily for us, the statistical models are out the scope of this reading, but unluckily that's probably one of the most fun places out of all of this. Active risk, tracking error, and information ratio. I'm going to jump on my soapbox for 1 second when it comes to the information ratio. I kind of want to change it a bit, but then again, who am I? I'm nobody. So, okay. What else? Potential benefits for investors as well as modeling asset returns, risks, benchmarks. Let's jump right into it. So, ladies and gents, I'm pretty sure that everybody in this room is aware of the capital asset pricing model. That in of itself is a factor model. It's a linear factor model that essentially just says that the market returns are dictated by beta. Now, there is a lack of evidence to say that a stock with a predicted high return by beta essentially has there's a large error when you take the forecast relative to reality. Okay, the root mean square error is essentially large. And what this essentially says is that if a stock has a high beta, it's kind of cyclical to the market, you should be rewarded for that cyclicality or bearing that uncertainty that comes through. Now, what happened is essentially the arbitrage pricing model came along to say, hold on, there must be something that explains how things move beyond more than this one naive thing that says, oh, there's this golden thread that infects the entire market. Now, what sits in the arbitrage pricing model? Ladies and gents, if you go to a hedge fund, there's a company at the moment that we're working with that we can't get access to their factor models because it's proprietary. It's essentially the same way as hedge funds using their rules-based decisions to tweak what's known out there to just eke out extra returns. There is no limitation of the amount of factors that go into the arbitrage pricing model, but econometrics will tell you that you need to have a sound economic basis for including something in advance. Why? Because what you see here, ladies and gents, is that there's various risk premiums and beta coefficients that get attached to that. That is, for all intents and purposes, just a multiple linear regression. Simple as that. Well, not disrespect. Now, what tends to happen for most instances is if I put a factor into that regression, this regression tool is going to give it a weight. Okay, even if it's some arb nonsense such as what the rainfall percentage was on a day-to-day basis around the world, I guarantee you statistically there may be an allocation. I'll guarantee maybe, but anyways, there may be an allocation. So garbage in, garbage out. But the point is, it's linear and there's no limitations. Now, ladies and gents, Your factor sensitivity or your factor beta essentially just says how sensitive your movements for this rewarded factor are going to be. Supposedly there's a size factor, and supposedly this size factor says by holding small capitalization stocks, you may get an extra 1% return per year, hypothetically. And if your beta or your factor exposure to this is 2%, oh, 2 times the premium that's rewarded to you, that's the expected return from that. Okay, that's what that says, as simple as that. How do you calculate it? We should all be able to calculate beta. It's the covariance of the market divided by the variance of the market. The linear regression just does it for you in the background. Sometimes you just use a MANOVA or an ANOVA table. Okay. And the factor risk premium, ladies and gents, there's a whole big hoo-ha about this. But basically, what you do to get rid of the market beta and to get a factor exposure is you come up with an idea. You say, I should be rewarded by doing this, small cap stocks. Okay? So what I do is I invest into a signal strength that I want, i.e. the bottom quintile of small cap stocks. I then short the top quintile of large cap stocks. And whatever that return is over time, voila, we have a factor. Simple as that. Now, combining all these magical factors, and I don't want to say that's a bit disrespectful, but you can ascribe a return to anything if you want. Buying shares on Tuesdays, okay, momentum over 3 weeks, momentum over 3 months, 6 months. It doesn't matter. All you're doing is you're describing the returns of the asset. And as far as it goes in reality, people like myself use these tools to try and explain away as much of a return as we can for a particular fund manager. And if there's anything left over, well, what do you know? We may have a holy grail in our hands. Okay. Now, another assumption of APT, ladies and gents, is that you can diversify away asset-specific risk. So what we're going to see quite often that pops up in this material is you're going to probably be given 3 assets. You're going to probably have to combine 2 of them to equate to a beta estimate or a return estimate of the third. And you're going to have to see whether the combination has a return greater or less than the one asset in isolation. Simple as that. Okay. And then diversified portfolios mean that no arbitrage opportunity exists, and there's no limitation to the amount of factors that you can put in here. Now, that's exactly that point over there. And asset-specific risk has gone. Oh, this is an important one. Both the CAPM and the APT assume that the market, the financial market, is in equilibrium. There's rates and there's assets in the market that can clear the market. So what it means from a basic overview point of view is that the buyer or the seller at the margin dictates. That's what it means. Okay. It's not the level of the market itself that matters. Now, ladies and gents, what you'll see, and this isn't the holy grail, it depends on what type of model you're using, but your expected return is going to be a combination of the risk-free rate. Why, for the discerning amongst us, do we remove the risk-free rate from these? Yeah? It's the rate that market gives anyways. And what is the point of risk-free? Risk-free means that there's no risk, there's no volatility, and importantly, there's no correlation to bad or good market outcomes. You get what you get, right? What happens if I add a risk-free asset into an optimization problem where there's essentially correlations considered? Well, the quadratic optimization problem now becomes a linear one, and you mess up the system. So you take the risk-free rate out and you put it aside. Then you have all the amount of factors that you want. We're going to have a look at a couple of models tonight, and I'm going to talk about one that's added on. And then right at the end, you've got an error term. Ladies and gents, that error term on average over time, the average should equal out to 0. If that average does not equal 0 over time, then there's something in here that can't explain away everything. And therefore, if we think long and hard about investors or about fund buyers or, fund evaluators, if we can't imagine what this is, and eventually over time it stays there, you've got true pure alpha. It's a holy grail. It comes and it goes. But anyways, now, what also is important that you need to see is that that constant depends on the context that we're talking about. So please keep in mind what that constant is when we talk about macroeconomic models specifically. Okay. By the way, I don't really see anybody do macroeconomic models in this way in reality, and we've worked with quite a bit of consulting firms. The second thing, ladies and gents, is imagine you had a world where your factor sensitivity is 1, but to every other factor it's 0. It doesn't matter. What we call this over here is we call it the pure factor portfolio. Now, ladies and gents, in reality, there's market participants out there that try and obtain this pure factor portfolio by allocating 100% to what the purest signal strength of it is. What do I mean by this? I mean, if I want a value stock, I rank the market by price to book, and I take the top 1 percentile, whatever that stock is. That technically should be the purest of value stocks that's out there. In reality, it doesn't work like that because it is a portfolio of factors. Okay, but that's what that means if it moves relative to 1 and the rest of it doesn't. Now, ladies and gents, we're going to start by the Farmer and French model. And I know when Russ was teaching me, pronunciations were funny things and people tended to get upset. So if I say Famer or Farmer, I don't give a crap. You just say what you want. Now, if I'm not mistaken, the original model came out in 1993, and essentially it was a 3-factor model. Now, what this says is that there's that market factor that CAPM originally employed. However, Farmer and French said, let's add on a size factor and let's add on a value factor. Now, what they says is that you should receive a reward in the general context for buying stocks that are smaller. Why? Because there's uncertainty attached to whether they're going to succeed or fail. There's less liquidity attached to it, but they've since stripped that out as its own factor. That uncertainty means that they should grow fast over time if you pick the unicorn. Now, value factor, ladies and gents, I talked about price to book. The opposite of value is growth, but there we go. Then in 2013, ladies and gents, there were 2 additional factors added on. Go do your own research about it. But what I'm trying to convey is that just like these series of factors came about, CAPM, Bull Sharp, Farmer and French, Passo Samba, Card 4 factor, they keep adding on and adding on and adding. Okay, so as financial markets develop and technology improves, we go for it. Now, what are we going to do if we want to try and interpret returns from this portfolio? You're going to be given a whole host of things on the table, particularly if you've gone to the back of your CFA book, you'll see some perfect questions on this that exist. Okay. You'll say, what is my beta coefficient, my factor coefficient, multiplied against my factor in terms of the absolute value itself? I sum these all up, and I'm going to get a particular return in totality. You just need to be able to, from this table that may have liquidity, may have momentum in it, know that for the Farmer French model, you only take those 3 relevant factors. So let's do an example together. And I hope I haven't cut your notes off too much over here. But ladies and gents, this is literally as simple as the application is. We're going to take our factor sensitivity and we're going to multiply it by the respective risk premium. So 1.2 times 2.5, I'll see on the next page that everything is essentially worked out for us. But what I just want to talk about over here, ladies and gents, is the following. Beyond that basic arithmetic, you may get a question that asks you for the following. Can you explain what type of portfolio this manager is taking a bias in? Now, if you know that I'm going to buy small caps, I should in principle be awarded for small caps, but I'm being penalized with a negative against this factor. You need to know that the opposite of small is large. That's not a Nobel Prize award, but then you just need to know that this manager's got a large cap bias or exposure currently at this point in time. That's the only magical trick as it comes to it right now. Okay. So, risk-free rate, once again, this is going to be given to you in the question because who knows what it is. But nonetheless, ladies and gents, we take all of it, all our respective rates, all our respective arithmetic, and we sum it up. Now, what's going to happen more so is this is just a basic concept checker. What you're more likely to see as a true exam type question is to use this model. You need to know what factors to select, and you need to be able to see whether there's going to be an arbitrage opportunity or not. And you're going to get given 2, 3, 4 different types of securities or 3 portfolios. That's where the magic lies. Okay. So as you see, if you repeat this arithmetic out, what this says is that the required rate of return is 6.61%. Ladies and gents, if your portfolio performs in excess of that, then you have an excess active return. Okay. And if you repeat that over time, well, maybe you have a bit of alpha. Okay. The pass to standby model. Basically, this model says that liquidity is a factor as well. Okay. So, ladies and gents, what does this mean here when we say that the beta liquidity factor is 0? It means that in essence, if you have a highly liquid stock, chances are that there's going to be a point in time where it transitions from a liquid stock to an illiquid stock. But basically, anything around that is only going to be a meaningful beta exposure. By stating that it has a liquidity factor of 0, it allows the academics to say that there needs to be some level of statistical significance. So, ladies and gents, if there is a liquidity premium that you get access to, and your beta, your factor exposure is positive, chances are probably you're going into an illiquid stock. Okay, how positive does it need to be? Well, you use statistics to see how many standard deviations it is away from the mean or whatever it is. That's the reason why they put it in there. So, it's very simple. We have the same factors as we previously did. However, now we bolt on liquidity. And ladies and gents, what you'll see is that this story rhymes. There's no rocket science yet. This is just memory parrot type stuff. Is that when we move to the Carhart model, what you'll see is that we're going to add on momentum now. And please do your homework on a day-to-day basis, because when you study this academically, it changes from a day-to-day basis in reality. And I can tell you why. Marketing angles for the most part. How are you as an asset management business going to get assets from the market when you do exactly the same thing as a competitor who has scale 20, 30, 40 billion of assets ahead of you? So, day-to-day business, we get creative and we change the factors. But this factor over here is probably the simplest out of all of them as far as it goes. So, we include the momentum factor, and basically, you need to be careful about this, but it just says that if the stock has been rising in its value, it should tend to rise in its value. And if the stock has been falling in its value, it should tend to fall. So one question I want to leave you with is, where's the turning point? And over how long do you measure this rise or the fall in price? Okay. Bear in mind that the more often you do it, the more trading costs there is. So, okay, but anyways. This is where the questions are probably going to come from if I had to take a guess. Arbitrage opportunity. Ladies and gents, we all know this. It's essentially where you don't have to use your own capital. There's no net investment by you. There's no risk associated with this investment. And still somehow you have the ability to make a profit. Now, I know for a matter of fact, and I can name the asset managers that can do this, but it's fleeting. It goes by very quickly. And if it doesn't go by very quickly, it's because it's very hard to get trading lines to those instruments. Okay. But nonetheless, it all comes down to generating a risk-free profit that we know. So, this is what this is going to look like, ladies and gents. You're going to be given some model, arbitrage pricing model. The question doesn't have to stick to the models that we've just very quickly gone through. But if they don't stick to it, they need to tell you what the factors are. And it's too easy to do that. Okay. So, what you'll have a look at, ladies and gents, is a factor that this portfolio that starts by this. Let's just explain X and Y in combination of each other. This is not where the magic happens. What happens is we have a diversified portfolio. We're essentially going to have a situation where the factor premium multiplied by the various sensitivities gives you the expected return of the securities. A subsequent question, or the question at the beginning, is then going to frame the narrative around the story to say, let's introduce some sort of additional asset to the mix. Okay. And they generally frame it separately so that they know which two you should associate with each other. Will it probably be that easy all the time? Maybe not. You need to discern. Okay. So what's happened is that you'll see there's two securities that we originally started with, having an expected return of 11 and 15% respectively. Then there's a third security that's introduced, and it has an expected return of 14%. Okay. Now, ladies and gents, what you'll then see, and is my math, 7 plus 6, 13. Okay, let's just go with it. My math is going to haunt me right now. But anyways, we need to test if this new portfolio introduces an arbitrage. That's right, because it, okay. We need to test if the new portfolio is going to introduce an arbitrage opportunity or not. And basically what you want to do is you want to create a portfolio of the existing assets. So ladies and gents, you take the factor weightings, this is just the simple arithmetic, and you'll multiply them out, and you'll see there's the 13%. Okay. So ladies and gents, if you can combine the two other portfolios and generate a return that's higher than the one that's been introduced, the golden rule is as simple as this. The question is going to say, which one are you going to buy or which one are you going to sell? And whichever provides you with the lowest return, you're going to short that portfolio, and you're going to invest it, take a long position in whichever provides you with the highest return. Okay. The rest of the arithmetic, ladies and gents, is very simple, but that's why I was just confused. My maths on the face of it didn't sit right. Okay. Now, what does this mean with some actual numbers? And we're going to have the wonderful experience together with economics again when we get to it next year, doing this with actual numbers. And we're all going to love it. But anyways, ladies and gents, what this says is that portfolio X and Y in combination provide me with an expected return of 13%. Now, if I then short that asset, what I then need to do is I need to replace that asset at some point in time. What do I need to do? I need to replace that asset with its given expected return, because that's the person that's borrowing it to me. Okay. Now, what I'm going to do is I'm going to invest the money, and I'm going to get an expected return of 14%. So based on R1 million or $1 million, that's going to be 1,130,000 versus 1,140,000. The 10,000 is essentially the arbitrage opportunity. I'd be very, very surprised if it's actually asked to you in terms of calculating the actual magnitude of the currency itself. It's probably going to stop at the point of which one would I buy, which one would I sell. Long, short, take a position in, as I believe it would be. Okay. Now, this is where it gets a little bit tricky. It's so dead easy. But I've been in your shoes, and to try and remember that one thing's associated with the fundamental factor and another with the macroeconomic model, it gets confusing. But I'm going to try to differentiate it for you as best as possible that I can. So ladies and gents, a macroeconomic model, besides the macroeconomics that plug into the model itself, I want to clearly just point out to you that the macroeconomic model, we'll come back to them in turn respectively, has some differences. The first difference that I want to tell you is that when it comes to macroeconomics, it's all about surprises. Okay, i.e., you have a look at today's announcement by the Reserve Bank, you have a look at what the expected interest rate was by market participants, you look at the FARs, and then you go look at what happened to the bond market, the R186 or whatever other access you can get information to. If we expected today that rates were going to rise by 50 basis points, so we prematurely sold our bond position in anticipation because we know there's going to be some duration to it, and rates only went up 25 basis points. Okay, at the margin, there's a positive surprise attached to that variable. Why? Because lower rates means less of a capital loss, and probably there's going to be an expected increase in return. But where was that original market data priced into? It's priced into there. Okay. Now, the y-intercept, or the variable without a coefficient. What does that mean for the other variables, ladies and gents? It means that to the right-hand side over here, we only discuss surprises. Everything else is already baked into the cake, and that's what the macroeconomic model is all about. If there is bugger all surprises, then what's the expected return for the question? There it is. And they're not going to be so kind as to clearly label it for you like that. Okay. So, economic variables, I think that's a giveaway with the macroeconomic in the name, but it's all about surprises. And there's no free marks for this. What is the surprise? Actual value less predicted value. How does this occur in reality? I don't spend as much time as some people in the room directly on equities, for instance, but if I want to reverse engineer what I believe should be going on, sense check the market, I'll take consensus earnings and I'll see where mine sits relative to that. But I'll give you one example. Thankfully, I'll use an example for someone in the room. Take ShopRite. ShopRite, the sell-side analysts that were essentially on that counter were late. They were lazy to publish. They were lazy to update the results. What happens? Then you can't get a true reflection of what's being expected by the market. Okay, so anyways, that's what this means. Let's move on to the next one, which is the fundamental factor model. Now, ladies and gents, what we've been talking about up until this point in time right now is all about factors. Okay, you get low investment, you get profitability, which essentially combines to quality, you get momentum, you get that, whatever. Doesn't matter. That's what this is. Why fundamental now? Because they look at the metrics of the institution directly, such as ROIC, ROE, gross profit margin, price to book. It doesn't matter. What this allows, though, is that it allows a cross-section analysis of all the counters. So, there is a change now. The change, ladies and gents, is that if we have a look, there is no longer surprises that are baked into the cake. So whatever that slope coefficient that we have over there is going to be, no apologies, the y-intercept is going to be, that is not the same as the macroeconomic model where that's not the expected return. Why? Because what you'll see is all these relative sensitivities now in the fundamental model are essentially stated as returns and not surprises. So you need to know your relative sensitivity to this return and what the expected return for that factor is going to be, i.e. companies that have high ROICs, high ROEs, people are going to probably favor them if something bad in the economy happens. Why? There's more margin for error. Okay, just some random example. Okay. Here's another difference. Standardized betas. Ladies and gents, standardization is essentially just taking the value of it there's your standardization. Now, why do you do that? Because you want to see what these standardized betas are and see how far away they are from the respective mean. Okay, so those are the two fundamental differences from what we've seen. Don't worry too much about the statistical model, because ladies and gents, oh well, here's an example right there, just there's the mathematical notation. You'll see that essentially, ladies and gents, statistical models as a final round off for the three models, and then we'll see how we can use them, is we only just need to know this in theory. And I promise you this is quite a tricky thing to apply in reality. But firstly, ladies and gents, statistical methods, they don't care about your creed, your consideration, your definitions, or nothing. It's just a statistical property to say, let's either explain the variance of the security itself, or let's explain how this variance co-varies with all the assets in the pool. Why? What do you want to do? Because if you can group assets together separately, then essentially you have separate factors that you can pick from to have correlations, hopefully less than one. So, factor analysis models, you just clearly need to note that the factor analysis explains the return covariances. Okay. The interrelationships between particular securities. Okay. What do you want to do in this basis? You want to try and separate them out into groups. And if you have a look at certain data providers that create maps, what you do, or a dashboard, what they do is they essentially use this as a component in their maps. Okay. And here we go, ladies and gents. Principal components. This sounds like the more fancy one. And when you have a look at the mathematical notation online, if you're masochistic, if you like punishment like I do, that mathematical notation will try and help you explain the return variances, not covariances, actual standard deviations of the particular asset. Okay. Okay, so let's move on to where it says, don't worry, it's outside the scope of the reading. And it's not just our opinion, don't worry, it says that in your CFA material as well. Okay. We've talked through that in some depth. Okay, so now we get to a situation where we need to put our analyst hats on and try and explain where things comes from and try and interpret whether things are being done in the correct way. Now, ladies and gents, we're going to introduce this by something called active risk. Risk is just essentially, as far as we're going to naively term it, if there is a variance in our expected outcome, we're going to go with the standard variance, the standard deviation definition. Now, the active part of it says that, ladies and gents, you're a manager, put your manager hat on. I tell you that I want you to try and outperform the top 40. You say, no problem, I've been looking at stocks for 30 years. You go immediately and you think, oh crap, if I could, I'd short the crap out of that stock. So what am I going to do? I'm going to have it at half its way to zero. Okay, now I need to put the extra money somewhere else. And as a result of this activity, you get a return profile that's consistent with your decisions to weight stocks. You have a return profile of your fund over here. You have the benchmark over here. You take the two returns minus each other, and that's your active return. It could be positive, it could be negative. It doesn't always have to be positive. You don't want it to be positive. Okay. Now, what we do, ladies and gents, is that we have a look at the standard deviation of the difference in the returns. By the way, that's all the standard errors are when you had a look at quants. That's all it is. It's all standard deviation just applied at different parts down the so-called value chain of arithmetic that you apply to the numbers. That's all it is. Now, this tracking risk just says that within a normal distribution, it doesn't have to be though, how likely are you to be different to what we expect the index to do? That's all it says. Now, as an active manager, you would probably want to be very different. But is there nobility in being different? Only if you get it right. And let me tell you, there's die-hard managers out there. We sat with a manager for about 3 years. This deep value manager. And he said, don't you worry. Next 3 months, it's going to come. Next 3 months. Okay. You're only vindicated if it's right. But how long do you have to wait to be right? Who knows? If you're a good manager, you can convince somebody for 10 years. Okay. But anyways, and that's what this means over here. Ladies and gents, what's a high or a low tracking error? Well, a passive manager that has a tracking error of 2%. You're going to have to ask, like, geez, why would I tend to be 2% off, 66% of the time, one way or another, in so-called normal environments? That I want exact. That's probably going to be too high for a passive manager. Give me exactly what the benchmark does. The only difference is the benchmark has no fees, and I've got to pay for trading costs. Okay. For instance, in South Africa, STT is 25 basis points for the trade in. You're already at a disadvantage. Tracking errors are natural. Okay. Here is where I'm going to jump on my soapbox. The information ratio. Ladies and gents, this ties into what we call the Sharpe ratio, and there's a million other. Basically, what you have is you have the return of the portfolio minus risk-free rate divided by the standard deviation. That's a Sharpe. What this wants to convey to us is that we want to see how much return we get per unit of risk. Okay, that's a noble exercise. Okay, but once again, what on earth is the definition of risk? This goes beyond that to say, okay, we're taking a slight difference here for information ratio because our risk is different. It says our risk is now going to be defined by the tracking error, how different we are to the benchmark in terms of the return variability. Now, ladies and gents, I want to ask you this. Here is your benchmark return, flat, 0. 0%, you make nothing. Here is our portfolio return, minus 1%. Is that difference static? It is, exactly the whole way. There's no variation whatsoever in the differences in return between these two numbers. Okay, but that's what that says at once. How different are the differences in returns? How variable are they? Can you outperform it by 10%, only to outperform it by 0.5%, then to lose 12? Then that's the problem. Okay, we'll circle back to that in a second. The same thing over here, ladies and gents, is that we have now the active excess returns, positive or negative. The holy grail for the information ratio is that you want it to be as high as possible. My return needs to exceed my benchmark return, have a positive return, and then it still needs to be above the differences in return and standard deviation. And then I have a tracking error of 1 or above. Now, I want to just put it to you, and my soapbox moment, please go think about it. Why do you have a difference in tracking error? Why should you not say, if I can outperform my benchmark, but do so at half the volatility, should my return not be scaled up to represent that I outperformed with half the volatility? I want you to just have some food for thought to say, standard deviation of the portfolio minus standard deviation in the denominator. This is not in your CFA notes. If you learn this, you will not pass the exam. But if you can apply it to different contexts, you can master it, and hopefully you don't have to learn it, you understand it. Okay. What else can multi-factor models be used for? Return attribution. This is a rabbit hole. Anybody that does this will understand it. It goes deep and deep and deep, but nonetheless, this just says, where did an investment return come from? And ladies and gents, what we're going to have a look at is the fundamental law of active management. And it's going to decompose this further into certain decisions. Okay. But nonetheless, we want to understand what the manager did relative to a benchmark to get what's on the table. Okay. The best one to use this is the fundamental model. Why? Because if we know the manager had a quality bias, we can essentially attribute, let's say, 90% of the excess returns to quality if quality outperformed the benchmark. What's the other 10? Well, the timing, the magical stuff, the knowing how to put it together, all the good stuff. Okay. So, the portfolio return, ladies and gents, please, if you try and box managers into this in reality, they're going to fight you. Every manager fights us when we try to do this because it's not a perfect science. But what you need to know is that the beta of the market return, plus whatever the active return is in the manager's portfolio return. Okay. So the reason why you do this is because you want to essentially strip this out. Okay. How do you do that? Well, right at the bottom. Return from factor tilts. I know that momentum is going to run hard right now. Okay. So I'm going to ride the trend. However, I know that exactly 3 months and 12 days it's going to turn. So I'm going to shift to consumer staples, whatever factor that says. Okay. Doesn't matter. How you do that in reality, Lord only knows how, but there we go. Security selection. Ladies and gents, even if I allocate, let's say I want a portfolio that says I want 20% to value, I want 20% to quality, 20% to size, repeat the exercise, and I do not deviate. I match my benchmark weights with those factors exactly, but I fill those buckets with better securities to provide me those factors. Voila, you have the next form of attribution. Okay, and of course the Carhart 4-factor model, but ladies and gents, in reality there's no prescription here. You can use any model you want. Okay, as long as it describes away that manager's style, bias, and flavor, you got it. Risk attribution. This is quite a big one, quite an important one. Okay, and this comes up as quite an often asked little formula that you need to remember. So just mark that out. Okay. So we want to understand in this section the sources of tracking error. Probably the most common method used in reality is what's called the marginal contribution to risk. And that was kind of purported and put forward by Thomas Edzarek, who also does some consulting to Morningstar. It's kind of rolled out from that. But basically, once again, the best model to use here is the fundamental model or statistical model. Okay. When assessing risk attribution, we use the variance calculation. Why do we use that? We use that because if you add a large number of securities into a portfolio, mathematically you can understand that most of the risk comes from the covariance structure rather than the individual standard deviations. Okay, and that can be proven quite easily. A second reason is that if you have uncorrelated variables in a portfolio, then the variances of each single asset are additive in nature. Okay. I tried to look into the maths of this. I know that it exists, and I've done just the simple arithmetic. I haven't yet figured out why. I like to understand why. So if there's anybody that understands that very well, please point me to somewhere where I can learn it. But this is what matters for you answering questions, is that active risk squared is essentially going to be the sum of the active factor risk plus the active security risk. What does that mean, ladies and gents? It means the following. If I decide to invest into quality, that quality is going to be the lion's share of that factor risk. But I can invest in the exact same quality exposure by getting stock A and B or stocks B and C. And the difference between A and B and C and D, is going to be the active specific risk over here. So you just need to know, and they're going to give this to you probably in a table format, that active risk squared equals active factor risk plus active specific risk. I'll probably bet my bottom dollar that you'll get a question on that. Portfolio construction. Ladies and gents, you can construct a portfolio using factors, and all this means is that you can take focused bets in the areas that you want to. What it also means is that you can construct portfolios that better match a manager's style bias. Why? Because if you know that a manager is just going to continuously play in cheap stocks, why not just create a benchmark of that? Okay, it's a more focused bet, a focused comparison. Okay, and also then you can just create portfolios that aren't correlated to the market or whatever else you want to do. In a passive management context, I'll give you an example over here. There's two ways you can create a benchmark. Let's say you want to track the Orbi, the 20 biggest bonds in South Africa, or the Govy, the 10 biggest government securities. You can just fully replicate it. You can hold the 10 of those securities. Well, there's no problem. What happens if you want to create a small cap index, though, or a mid cap index? There's a provider that does it, an ETF. You can't own all the securities all the way down to the tail. There's no liquidity. You use a little bit of maths, you use a little bit of factors, and you can essentially hold the most liquid of them and optimize for the remainder. Okay, it's a wonderful, beautiful world, but it allows us to do that. And like I said, better predict alpha or relative returns. True alpha. Okay. Strategic portfolio decisions, basically, ladies and gents, you can take these factors, you can apply them in the long run as to what may be the best outcome. Some market participants are proponents of the fact that if you buy a good quality business that has a high profit margin, where ROIC is above WACC, and they've got a moat around them, the so-called quality at a reasonable price, people, that in the long term is a factor that strategically should pay off the most amongst factors themselves. Whether you believe that or not, I'm not here to say that that's the best. That's just what they purport to. Okay. And we're done. So, ladies and gents, just to tee you off next week is going to be a little bit longer. What we're going to start getting into is we're going to start getting into the risk premiums of things. We're going to also start teeing ourselves up for the fundamental laws of it all. And if I could recommend that you do one thing in advance, it is please go to the end of your notes, go to the end of your CFA textbooks and start doing questions. So that from now till the end of whenever you want to stop studying, you just study what you got wrong. Not that I know how to study, but that generally worked for me and a couple of other people I've talked to. If you need any help, give me a shout, but I'll see you all next week. Ciao.